We always assume presidents want the stock market soaring, right? It's like the default measure of success.
Totally. A booming market looks good, feels good.
But what if the thinking in Washington right now is actually, well, the opposite? That maybe the U.S. actually wants the market to cool off a bit.
That definitely cuts against the usual grain, yeah. We usually see a strong market as, a sign of a healthy economy.
Exactly. But sometimes there are these less obvious strategies, maybe.
Could be. And that's what we're really digging into today.
We've got this FinShots article from March 12th, 2025, and it lays out this honestly surprising theory that the Trump administration might be deliberately letting the stock market dip, maybe even encouraging it.
Allowing it to fall.
Yeah. So our mission here is to try and understand the why, what's the logic, and of course, what could happen because of it.
Okay. And the article seems to float, two main ideas for why the market's been acting this way.
That's right. The first one touches on Trump's talk about globalists. And then there's a second, sort of deeper theory about a deliberate administration strategy.
Right. The second one feels like the main event here. But maybe we should quickly cover that first globalist angle, just for context.
Good idea. So, theory one. Trump mentions globalists. The article suggests this could mean foreign investors holding U.S. Treasury bonds. China's the example they use.
Okay. And the link is the trade deficit. U.S. buys more from China.
Then China buys from the U.S., so China ends up with a whole lot of U.S. dollars.
Right. And what do they usually do with those dollars? They often buy U.S. Treasury bonds because, well, they're seen as super safe investments, basically lending money back to the U.S. government.
Exactly. So this first theory goes, if the administration shrinks that trade deficit, maybe through tariffs or whatever,
Then China has fewer dollars floating around.
fewer dollars to buy those treasury bonds. And that reduced demand, the theory suggests, could maybe hurt bank profits somehow and maybe cause investors to sell stocks?
It feels like a few steps removed, that chain reaction. Trade balance influencing bond demand, influencing banks, influencing the stock market.
Yeah, the article itself kind of says it's speculative. Like, who exactly are these globalists in this context? And is it really a deliberate plan to lower the market this way? It says no one knows for sure.
Okay, so an interesting thought, but maybe not the core explanation.
Agreed. Let's move to the second theory then, the one that feels much more central to the article's argument.
Which is the really counterintuitive one.
Yeah.
The administration intentionally letting the stock market fall.
Right. It sounds bizarre. Why would a president want that? Usually it's all about pumping the market up.
Well, the reasoning outlined in the article starts with a belief, apparently within the administration, maybe articulated by Treasury Secretary Scott Bessent,
Ah, yes, Besson.
that the economic growth under Biden, while looking good on paper, mostly benefited, say, the top 10%.
While the bottom 50% weren't really feeling it, still struggling.
That seems to be the argument, that the gains weren't broadly shared, that it was too focused on maybe consumer spending driven by the well-off.
Okay, so this isn't just letting the market fall. It's about trying to, what, rebalance the economy somehow.
That's the idea presented, a
Yeah.
fundamental shift, moving the U.S. away from an economy that relies so heavily on consumer spending, the demand side,
Right.
towards one that's powered more by business investment and production, the supply side.
Okay, let's unpack that. Why the worry about consumer spending being the main driver? The article mentions debt, bubbles, inflation.
Exactly. The argument is that relying too much on people buying stuff has helped rack up this massive national debt. What is it, $34 trillion now?
Wow, that's a lot.
And a huge chunk of that, like $7 trillion, needs refinancing soon. If interest rates are high, that gets incredibly expensive. Plus, too much consumer demand can fuel inflation and create asset bubbles, where prices get detached from reality.
Okay, makes sense. So then,
Yeah.
how does a falling stock market fit into fixing that? How does that help pivot to a supply-side economy?
It's kind of direct, actually. The theory is market goes down, investors get nervous,
Naturally,
they sell riskier things like stocks and look for safety. And what's seen as super safe,
U.S. Treasury bonds.
bingo. So more people want to buy bonds. Basic
Mhm.
economics, demand goes up, price goes up. And crucially, when bond prices go up, their yield, the interest rate they pay, go down.
Okay. And lower yields on those bonds, especially the key ones like the 10-year Treasury.
Yeah.
The article mentioned it dropped from like 4.8% down to 4.25%.
Yeah, around then.
That must save the government a ton of money when they have to refinance all that debt you mentioned. Trillions of dollars.
Absolutely.
Wow.
Even a small drop in the interest rate translates to massive savings when you're borrowing on that scale. Billions. Gives them breathing room.
Okay, so falling stocks, nervous investors buy bond prices up, bond yields down, cheaper government borrowing. Got it.
That's the mechanism they seem to be banking on.
But the article also talks about a controlled slowdown, not just lowering borrowing costs, but also resetting inflated asset prices. What's that about?
Well, the thinking there is that maybe years of easy money and strong consumer demand pushed asset prices, stocks, maybe real estate, too artificially high, creating potential bubbles.
Right.
So a controlled dip, a slowdown, could sort of gently deflate those bubbles, bring prices back to more sustainable levels, setting the stage for, theoretically, a healthier recovery later on.
Okay. Now, tariffs. This is interesting. Normally we think tariffs mean higher prices, right? More inflation because imports cost more.
That's the standard textbook view, yeah.
But this article suggests the Trump administration might be using them differently.
Exactly. It's a bit of a twist. The theory here is that the unpredictability of the tariffs, the constant changes and threats, that's actually spooking investors more about an economic slowdown than about inflation itself.
Ah, so it's the uncertainty factor, disruptions to supply chains, not knowing what's next, that makes businesses and investors pause.
Precisely. That uncertainty makes them worry about future growth, future profits.
Yeah.
So what do?
They sell stocks.
And buy bonds. Again, achieving that same effect, pushing bond yields down.
So the tariffs become this tool not just for trade leverage, but to deliberately create market jitters that serve this other goal of lowering interest rates. The article points to Trump constantly tweaking his tariff stance as maybe evidence of this.
That's the interpretation offered, yeah.
Yeah.
Keep them guessing, keep them nervous, and maybe you get the market reaction you want for lowering borrowing costs.
Okay, so tariffs are one tool. What else? The article mentions government spending cuts playing a big role, too. Bessent talking about a detox period from public spending.
Right. This is the other side of weakening the demand-driven economy. The article lists things like cutting government jobs, potential cuts to Medicare, less money for food assistance, housing aid.
Wow, those are significant cuts.
They represent pretty broad reductions in government spending across different areas.
And the goal there is pretty straightforward, right? Less government spending means less money going into the economy, less demand from consumers and government itself.
Exactly. You weaken the demand side directly. And then the idea is you try to balance that by boosting the supply side.
Which is where the lower corporate taxes and deregulation come in, hoping businesses will pick up the slack with investment.
That's the plan, seemingly. Cut demand through spending cuts, boost potential supply through tax breaks and deregulation. A classic supply-side playbook, in a way.
The article sums this whole package up, the tariffs, the spending cuts, the business tax breaks as kitchen sinking. Like, throw all the potentially painful stuff in at the beginning.
Yeah. Front-load the economic pain, get the tough adjustments done early to supposedly build a stronger foundation for later.
It sounds like a massive gamble, though.
Absolutely. High stakes. The intention might be this long-term restructuring, but the immediate risks are huge.
And the article lists them. The biggest one being, obviously, you could just tip the whole economy into a nasty recession.
That's the nightmare scenario for sure.
Yeah.
If the slowdown isn't controlled, if it spirals.
It mentions Jamie Dimon warning about America alone backfiring, Canada maybe cutting electricity exports. These things have consequences beyond just the U.S. market.
Definitely. Global trade is interconnected, options have reactions, and messing with trade relationships can have unintended negative ripple effects.
And prediction markets like Kalshi were putting the odds of a U.S. recession this year at, what, 40%? That's pretty high.
It certainly reflects the perceived risk out there. A lot of uncertainty baked into those odds.
But here's a twist. The article notes that the market expecting the Fed to cut interest rates multiple times in 2025.
Yeah.
That actually fits right into the administration's goal, doesn't it? Lower rates.
It does, in a way.
Yeah.
If the market anticipates a weaker economy because of these policies, it will naturally expect the Fed to step in and cut rates to try and support growth.
So the market's fear could actually help achieve one of their main objectives.
It's a potential side effect, yeah.
Right.
Whether intended or just a consequence, the expectation of lower rates is there.
And supporters, as you'd expect, are probably framing this as necessary medicine. Short-term pain, maybe, but leading to long-term gain with lower interest rates, stronger businesses, benefiting Main Street, not just Wall Street.
That's the narrative you'd expect, yes. A rebalancing act designed to eventually help average Americans through job growth and a more robust underlying economy.
But what about the short-term pain for those average Americans? The article raises serious concerns there. a crashing stock market that hits retirement savings hard, right? 401ks, IRAs.
That's a huge, huge risk and a very real potential consequence.
Yeah.
For millions of people, their financial security is tied up in the market. A big downturn could be devastating for their future plans, their retirement.
And this kind of major economic shift, it's not quick, is it? The article stresses it could be long and messy. The pain might last longer than expected.
Economic restructuring is almost always a difficult process. It takes time, there are disruptions, winners and losers. It's rarely smooth.
There's that quote from the Alcoa CEO, William Oplinger, talking about how companies like his make investment decisions over decades, 20, 40 years. How can they plan big investments if tariff policies keep shifting unpredictably?
That's a critical point. Businesses, especially those making huge long-term capital investments, crave stability and predictability. Constant policy uncertainty makes them hesitant to commit that kind of capital. It can actually stifle the very business investment the administration wants to encourage.
And even the Fed chair, Jerome Powell, is quoted sounding much more cautious, basically saying, hey, the economy's okay, let's not rush into anything drastic, let's wait and see.
Right. Powell representing that more traditional, data-dependent, cautious approach. Let the situation evolve. Don't make sudden moves unless absolutely necessary.
Which seems like the polar opposite of this administration's apparent strategy, which is much more disruptive. Let's shake things up now.
It highlights a fundamental difference in philosophy, doesn't it? Stability versus disruption as a tool for change. Caution versus immediate action.
So the article kind of leaves it there. It's a big gamble. Supporters and critics are watching the same unfolding reality.
And eventually, the results will speak for themselves. The economy will go where it goes.
Someone's likely going to be pretty unhappy with how it turns out.
That seems almost certain. It's hard to see an outcome where everyone feels like this was the right path.
And the article suggests we should be watching things like interest rate movements, Fed decisions. Those near-term indicators might give us clues about how this gamble is actually playing out.
Definitely. Those are the vital signs. Along with inflation, jobs, gross numbers, that's where we'll see the real-world impact.
Okay, so let's wrap this deep dive. We've looked at this really unconventional idea that the current administration might actually be okay with or even encouraging short-term stock market pain.
All with the goal of engineering this long-term shift towards a supply-side economy.
We touched on that globalist theory, but mainly focused on the strategy involving tariffs used for uncertainty, government spending cuts to dampen demand, and tax breaks to boost business.
But we also spent a lot of time on the massive risks. Pushing the economy into recession being the big one, but also the impact on people's savings and the uncertainty for businesses.
It really boils down to this tension. Is the potential long-term gain of a restructured economy worth the very real risk of significant short-term damage and hardship?
And we just don't know the answer yet. The strategy is bold, maybe even reckless depending on your view, and the outcome is far from certain.
So here's something for you, the listener, to chew on. As you watch the news in the coming months, what specific signs will you look for? What numbers or trends will tell you if this high-stakes economic strategy is working, or if it's starting to go off the rails? And maybe more importantly, what could the end result mean for the economy overall, and maybe even for your own finances down the road? Lots to think about.